Dear clients, I'm Richard, Phillip CFD dealer. The major US equity benchmarks ended last week pretty much flat before tumbling down yesterday to end the month of July in the red. A snapshot review of July's market literature suggests that market participants are caught between the cross currents of better than expected corporate earnings and an encouraging trajectory of job market improvements against the uncertainty arising from the policy rate hike prospects and the ongoing Western versus Russia political tensions, and even some reminiscence of the Eurozone crisis driven by negative credit news flow from the troubled peripheral Eurozone banking sector. Now, as far as the Q2 earnings season is concerned, to date, it has provided a positive tailwind for the risk-on environment. FactSet reported last Friday that more than 3/4 of the companies that had reported earnings have exceeded analyst expectations, prompting upward revisions to their Q2 earnings estimates. Although a handful of proxy names, for example, Amazon, Visa, Exxon, etc., they reported disappointing results versus estimates, which caught some market participants off guard, but by and large, did little to dent overall market sentiments. On the cross-markets front, a good indicator for equity participants to keep a watchful eye on is the yield movement of the high-yield bond space, as both markets tend to move in tandem, especially if credit market concerns in Eurozone or in Latin America take center stage. Apparently, in response to the ongoing geopolitical and credit market uncertainties, high-yield participants are switching over into safe haven treasuries. And this was one of the contributing factors to the flattening of the US Treasury yield curve, with the long duration well bidded for its safe haven carry, whereas the short-term maturities were shunned given the prospects of rising policy rate next year. The point I want to make here is, notwithstanding that global policymakers and key leaders are providing market participants with the impression of a global monetary and political landscape that is being kept in good shape, cross-market actions are still pricing in the above-mentioned concerns, which may potentially set ripple effects hitting onto the equity shore. Hence, bottom line is, beyond the remaining 2 to 3 weeks, summer weeks of likely positive earnings flow, I believe that market participants' attention may turn to potential autumn issues ranging from increased noise from the hawks chattering about the Fed stepping out of the way as markets await the next FOMC policy statements on 18th of September, to reigniting anxiety on the fragile state of the Eurozone credit health being and the Western-Russia standoff. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's market video. I'm Richard from Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.